Well, good evening, everybody. Welcome to your session today, and I hope you're all well and have had a good day inside and outside of the markets. And of course, as we start, we're going to just remind you of the key message that these opinions are mine only, although this is less to do with direct market action in terms of looking at live markets. We may well have a little peek and see what's going on, of course. And because of that, just a reminder that this is for educational purposes only. You should do your own due diligence and trade with your trading plan with anything that you see or hear, and manage risk well always. So that being said, great to see you all here. Let me know that you can hear and see me okay. That would be fantastic. Wonderful, Ian. I hope it's great in Lightning Ridge. Thanks, Michael. Yeah, all good. Good day, Shane. Good evening again, David. Hope you're all well. Just checking out who's here. Now, awesome. Cheers, Don. Thanks, Shane. Great stuff. Looks as though we're all good to go. G'day, David, Grant, Richard, John, Rob, etc., and Rod S, and Ewan, and Rachel. No, it wasn't warmer today. It was blooming freezing this morning. It was a beautiful sunny day this afternoon, but it was cold in Perth today. It got down to -2 last night. Sorry, not -2, doesn't get minus here, but 2, which is pretty damn cold whichever way you slice it. Anyway, let's just have a chat about the markets first, look at what's come across the news. Of course, it's been a bit of an interesting week on markets since we last met. We've had the Fed come out and suggest they may raise interest rates a couple of times in 2023, and they may start taking back their asset purchase or tailoring back their asset purchase tapering, I think it's called, program, but they'll let the markets know when that is. The markets took that as being that's signs of inflationary pressure. Then the Fed had to come out and say, hey, chill guys, we are expecting inflation to be high next year, but we expect it to be back in our target between 2 and 2.5 next year. So the market's been up and down like a yo-yo, but after all of that, we're still in the Nasdaq at record highs, the S&P 500 pretty close. Stocks continue their way up. We've had the dollar spike higher, but pull back in the last couple of days. You had a commodity sell-off across the board. Precious metals look miserable, as did base metals, but we've seen them recover to some degree. We'll have a look at all of those in a moment. In terms of today, today's really been about PMI data. We'll have a look at some of the economic data that's come out so far and what's to come out next. Tomorrow's going to be a doozy, particularly in the US, because we've got those weekly jobs numbers come out again, being Thursday, as well as the some GDP numbers as well, which are going to be pretty important. So let's just have a quick look at this in more detail. Let's start by having a look at, we have got internet, come on. There we go. We'll have a look at the futures, and you can see that these have come off a little bit from their high. We're expecting them to do better, but the European markets have sold off a little bit, and that's just pulled the futures down a wee bit. Currencies have been all over the place, but the yen is getting smashed compared to most currencies. We'll have a look at a couple of potential opportunities there. With that US dollar not moving up anymore, we've seen gold and silver recover a little bit. Brent's over $75, which is more than a 2-year high now. And we're seeing a little bit of recovery in copper. Copper dropped to around about around about $4.12 at its low. But we're seeing a nice V shape on that right now. So consequently, both copper, CFD, and share CFDs related to copper, such as Oz Minerals, are doing pretty well over the last couple of days. Okay, and on the economic calendar front, so just a few things coming out that we've talked about there. We'll have a look first of all at some of the PMI data that's come across already once it updates. So what we're most afraid of, what the market's probably most afraid of, is these numbers getting too hot. But we've actually had good numbers without them getting too extraordinarily hot. which is probably why the euro's doing pretty well now. You can see those numbers are all beating expectations, both on the services side and the manufacturing side. In the UK, we're seeing the services still struggle a little bit, so not too hot, but and the manufacturing just come in over expectations. Japanese and Australian figures came out this morning. PMI again on the manufacturing side and services side, both were down a little bit compared to expectations. So again, not too hot, which is probably keeping markets in a reasonable place. We've got that coming out of the US later. So again, providing these come out at or below expectations, we should be good for continued rise. Now tomorrow, as I said, big day. We've not really got much coming out in Asia of any note, but then it ramps up. We've got the interest rate decision coming out of the UK, and then the US, we've got initial jobs and GDP. Now, the other thing to say is this personal consumption expenditures prices. This is the one which Jerome Powell likes, the Fed chairman. So again, we just need to make sure that that's not pushing to or getting too hot. If it does come in much above that 2.5%, then we could see markets have a little bit of an inflation twitch again. That is, and durable goods are quite important. Again, expected to be a good number. Would hope that continues to do okay without, again, blowing expectations. Also got some stress tests coming out of the US on the banks, but they should be under no pressure at all. And then really quite a quiet day on Friday to end the week. So expect some choppiness over the next couple of days, but could, providing numbers don't come in too hot, there's no reason to suspect things are going to sell off. And the current buying on any dip is likely to continue. So there we are in terms of where we're at. So what does that mean in terms of charts? Well, let's just have a look at some stuff. US 500 daily. So this is record highs we're playing with right now. You can see we're just trading around that. We had that little pullback last week, which was really just, as I said, a little pullback of less than 2%. And we've bounced right back up again. The NASDAQ, let's just check a NASDAQ chart. I thought this might pop today, but it really failed to get infused after the US market opened. But so you see we're pretty neutral on the day, as we saw already, but you can see there that's record highs that we hit yesterday in trading. So sort of doing okay on that. Just let me just do a little bit of a just gonna close a couple of things down that may be hurting us slightly in terms of bandwidth. There we go. We'll just close those down. Now we've done that. All good. Right. Okay, we need to go back. There we go. So in terms of we didn't mention cryptos, but cryptos have been pretty miserable over the last few days. We'll just drag a Bitcoin. A Bitcoin chart on just to show you the potential damage. Now, this is sort of holding on okay. Just watch this 30,000 level, which we dipped below yesterday, but managed to recover. This is the key level here, just over 30,000. If it breaks that, we'll see some selling that you've never seen before in cryptos. If we look at gold, we'd expect that to be due. Also, we'll look at the US dollar index first. You can see that pull back. That's actually doing okay. That's actually doing okay right now because we've got a we've got that slight sort of come off the ball from the US futures. So the US dollar is actually trading reasonably well at this stage after that massive move higher. There's the retracement. Now with that retracement, we would expect gold to be doing well. It's not. There's that fairly major sell-off we had over the course of last week, which really in the course of 4 or 5 days took us down around 8%, which is massive for gold. came down, tested that 1754 level, and has bounced on that. But it could be that we enter a range like we were in sort of towards the back end of April. There doesn't seem to be, if there'd been any appetite for buying back into this, it may be because it's below the 200 MA, then we would have already seen that. Copper, I mentioned, copper is trading on a nice bounce off that 413 level we talked about before. So we're in the next futures contract, which runs until August. So we had a rollover of that last week. Price popped up a little bit on that, but that's a nice bounce, and that's why we're seeing some relatively good news in the commodity, some of the commodity stocks. As I said, Oz Minerals being an example. So there's a 4-hour chart. You can see that nice bounce coming to pass the shorter term moving averages crossing on the 4-hourly chart. All good. All good. Thank you for the heads up. Read the charts. Now, with that US dollar strength, we'll have a look across some of the US dollar pairs to start with. Now, obviously, with that, we saw most of the pairs versus the USD rocket down towards support, and now we're getting a bounce. Now, just be aware of this 200 MA on the Euro USD. So, although we're trading towards the top of the candle, we don't look as though we've got the appetite to break through that yet. If we do, then we could be in a good place. US yen, as I said, yen is doing pretty miserable today, and then we've got an important break on the USD Japanese yen daily. If we look at the Aussie, here's much a similar picture on this. The difference between this is it has broken its 200 MA, but there is this key level at around about 75.80. So be patient, let it break through that before you consider a long trade in that. You can see that more clearly on there. And there should be a fairly easy ride up around about even as high as 100 pips on the hourly chart. Now, with Euro doing okay, yen looking a bit weak. There's the Euro yen going great guns at the moment. It did, so essentially it broke through that level, came down. I think that was on some data, just touched it for a very short time frame. There we go. So you can see even on the 5-minute chart, it came down and just touched that and moved straight back up again. That stop loss has been moved up from its original as we see this, and we'll probably do that again to look at some of this stuff because that's now looking pretty hot to trot. So there we're looking $560 on that and see what happens over the next little while. But that yen weakness continues. The euro looks strong, particularly on the back of those PMI numbers. Is there a chart for lithium? Good question. I don't think lithium is traded on global markets. We'll look at the lithium ETF chart, which there is one tradable in the US. Although that's lithium and battery tech, so that's gonna actually be a. So let's put it on a 1-month chart. So that's what's happened to lithium and battery. So that's the impetus behind this, and that's what we've talked about previously in terms of lithium. This is just going to get bigger and bigger. So if we look at what's happening here, then we'll just pop on a PLS chart. I actually bought some of these towards the back end of the day, and it dropped off a little bit, but just take this out. You can see how now this is at record highs, potentially a good long-term hold. So no, because lithium isn't directly traded, but we can see it on the ETF. We can see a price chart for what it costs. A couple of other things, APT, have been a favorite time and time again. I actually took some off today. I had a couple of positions open just because it's getting near that 126 level. if it does break that level there, you can see how it paused around April. If it does sort of break perhaps 127, then again, it looks like a pretty interesting trade going forward. Elsewhere, if we look at GB Pound Aussie, this was one that caught our eye a couple of days ago, but really hasn't broken through that 184.90. So it could be that everything versus the yen is good. If we look at GB Pound Yen, just let it catch up a little bit. There's the daily chart. You can see a really nice V-shaped bounce on this. We'd have to be patient with this though. There is the level at 155.27. A breakthrough that wouldn't see us up very far. So I think there maybe about 50 pips. So I think there's possibly better opportunities elsewhere in the currency markets than that. Oil worth referencing. So let's just have a quick look at UKO USD. As I said, Brent continues just to move higher, much to my surprise. It's now broken 75. Just put this on a weekly chart, you'll see context. So we have to go back quite a long way. In fact, back to where's that, about September 2018. Last time was at this level. This was a key level here that we broke through around about $72. You can see how it was there at the back end, really the front end of 2019, and again in January this year. So we broke through that, and we're moving in our $5 increments. So if we take 75, our next stop is around about 80. If previous price action is to be believed, and you can see how much resistance there is there. But because production cuts are still in place, that's part of the reason this is happening. And of course, on top of that, we've got obviously an opening global or relaxation of global lockdown measures as we move forward. So there's a couple of things to have a look out for there. I hope that's been useful. Anyway, let's get on to our educational topic of the day, which is preventative versus promotional bias. Now, let's just look at how trading results occur. We've done this before. It's part of that Trader IQ framework that I've been putting together, and the entity that goes along with that. So we've got market action, we've got what happens in our minds, so it's an interpretation of that. We've got applications or development and applications of systems, because obviously we've got to have the learning and the motivation to develop those systems, as well as to apply them in the trading context. And then we've got decision making and action. And then, of course, that produces the results at the end of the day. However, we have these things called cognitive trading biases, which can impact just on the point at which we press buttons. So either at time of entry or times of exit, that's when our biases kick in and can really scupper our performance as a trader. So what I'll do is I'll just give you a little, I don't know why that's there. So what do we mean by a bias? Well, it's a potentially damaging automatic heuristic that kicks in at the time of action. Now, heuristics are those sort of inbuilt subconscious ways of thinking and doing that we carry around with us. And regardless of how knowledgeable traders are and the systems they have in place, there are these things that as they're making decisions and about to press the button, there are these things which are existing behavioral biases which kick in and cause them to stray away from what they may have originally intended to do. And there's a whole field of science called behavioral finance, which looks at this as part of a major part of its syllabus, I guess, for want of a better term. And of course, because the trading context is quite complex in terms of the number of things that you have to put in place to make a decision, and the intensity that, particularly in shorter time frames, that often occurs in a trading context as well, then these often get exaggerated. So the things we already carry around with us, but get exaggerated because of those two issues. So the more complex an issue is, the more likely a heuristic is likely to kick in. And as a minimum, they can limit your potential. Okay, I mean, let's not mess around here, because we don't do that. I'll tell you how it is. So as a minimum, it can limit your potential, and at worst, can severely threaten performance and subsequently trading outcomes to the point which you may well think, right, trading's not for me. I'm out of here. And all from the point of view of you've got these automatic things that kick in. Now, we've covered some of these before. There are 5 that appear to be common as so-called loss aversion bias, which is related to some degree to preventative bias that we're going to talk about today. I've actually spelled preventative wrong, sorry about that. Got a recency bias, which means that you just view your value as a trader and some of your actions on what's happened recently. So it may be that a particular thing has done the same thing for a couple of days, so you're therefore automatically assume it's going to do the same thing. Or it may be that you've had 4 or 5 poor results as a trader on the spin and you think, right, that's it, I'm rubbish at this. There's minimalization bias, where you don't do the things which you should do before you enter a trade and when you exit a trade. There's an outcome bias, which is very similar to recency bias in how we've described it, in that you judge your worth as a trader by the dollar figure that you attach to a win or loss, when of course, as we talked last night, really your results as a developing trader should be really a barometer for what you need to do, what you need not to do, and on which to base a judgment of the impact of change. And then there's some cost effect, and that's really less relevant in the context of the way that most of you trade. But it be the example being, or a good example being perhaps, BHP used to trade at $50 and therefore BHP is worth $50. So you assume that whatever you paid for something is what it's worth, and therefore just ignore everything else that's going on. Now, in terms of tonight, we're going to look at preventative and promotional biases, because these, I would suggest, are the most common and take into account some of these other biases that exist. So what I'm going to do is I'm going to go through what this means, in terms of a definition, but also start to look at what the symptoms are, what the characteristics are of each of these, because it's one of these things that I think all of us have in us to some degree. It's just that what degree is what differs depending on the individual, as well as which side of the fence we fall. Now, I'll start by saying, hi, my name is Mike Smith. I am a trader who has a promotional bias. Okay, so a lot of this comes from, when I was preparing this today, I sort of looked at this list of the characteristics of someone with a promotional bias, and I thought, that's me, that's me, that's me, that's me. And so really what I want to do is put these in front of you and see which may be a fit for you. Not to dismiss you as a trader or to be critical, but just to say, look, these are the signs that something may be going on here, which if you're aware of, you can start to put some things in place to address them. So that really is the aim of this session tonight. So as I go through the list, and I'll warn you when that is the case, then I'll talk about that in more detail. So generally, when they're not often referred to promotional or preventative biases, although that's sometimes referenced. It's a bit of a Mikeism, really. More often they're termed optimism or pessimism biases in the literature, but there are particular things that happen or don't happen in a trading context that I feel merit, rather than just a general investment behavior, or rather than a general investment context, that I think really suits the terms of prevention and promotion. And as I said, these can develop over, I've not finished the sentence off there. These can develop over time outside of trading and then are exaggerated accordingly once we get into the context of trading. And my experience of working with people like you, and certainly from what I've seen, and certainly looking at myself as a trader, would tend to suggest that all traders have a natural tendency to move one way or the other, to either have a little bit or a lot of prevention, or a little bit or a lot of promotion. There is a school of thought which suggests that that there may be, actually, maybe I'll leave that till later, but I'll just plant it now. For those of you who already know something about this, it may be that you have this particular bias in a particular set of market circumstances. And it doesn't exist in other market circumstances, but I think that's probably another story for another day. So obviously the degree, let's say there's a central point there, and on one side there's prevention and one on the other side there's promotion. Then we have an individual point at which we are as a trader, which is going to be different depending on who you are, what your previous experiences are, both in a trading and a non-trading context. And obviously the extremes of either side are where the major dangers lie. But one of the things that often happens with these is that they tend to, they start at a particular point and may get worse over time if not addressed. And if you look at the goals when we look at this sort of stuff, the first goal is obviously awareness and acceptance that this could be me as a trader. So ownership, and then putting in the place of things which will address that mismatch. So we'll bring you back closer to a central point. And just to say, it's something that you have to revisit. You will continue to have to battle with this over a period of time. In most cases, and certainly in my case, that was the case. So as I said, your challenge really, as we work through this session, is develop an awareness and owning where you are now. And so as we work through the characteristics and the symptoms and the results that often occur because of these, I want you to sort of have a think about, well, look, how much does this resonate with me? Does this mean I am here? And if so, then what do I need to do about it? So that is your challenge with today's session. So make notes as we go. Now, in a little more detail than that, then what tends to happen is if someone has an optimism or a promotional bias, it causes someone to believe that they're more likely to get to experience a positive event or less likely a negative event. So the focus is on positive, positive, positive. It's getting results, it's pushing things forward. It's and it results in promotional behaviors or symptoms accordingly, which we'll cover soon, to optimize the chance of this positive event occurring. It may be associated with a feeling of being in hyper control. So there is many things in terms of your trading that you're in control over. Really the only major thing that you're not is price movement, which obviously is pretty big, but nevertheless, everything else in terms of your decision making, you are in control of. However, those with a promotional bias may start to believe that they're able to feel the market. And if you're of this disposition, then it's very easy after a few trades that go your way to start to, there is a link between an optimism bias and overconfidence. And so you may see people exhibiting signs of that as well. And again, I'll talk about that as we go through. If you're the other side of the fence, i.e. with a pessimistic bias or a preventative bias, you may feel less in control than you actually are. So you may be giving control away. So listen to your internal voices about what you're saying about trades that you're in. It's the market's fault, or look at that, or so refusing to take control when actually it's all with you. And your feeling is one that you're more likely to experience a negative event, and so the symptoms or the things that you put in place are designed to reduce the chances of that happening, okay, or avoiding negative events. So optimism bias or promotional bias is when you're putting things in place which are going to make you more likely to embrace the positive but ignore the negative, and vice versa for pessimism or preventative bias. I did see a couple of quotes of this which said a pessimist is an optimist with experience, and I think that's BS, to be honest. I think it completely misses the point, but I guess does suggest somewhere a balance between the two. If you are an optimist, then a degree of focusing on those on the possibility of negative events is a good thing, and vice versa, of course. Okay, so let's look at qualities first of all, because there are good things about both sides of the fence. So if you have a promotional bias, then you've got this attitude that not all options will succeed, and that not all will fail. So there's quite a positive outlook to you as an investor in the potential of this. And that, well, look, if it doesn't work, well, look, it doesn't work. So rarely go in with this attitude of this is money. This is money I can afford to lose. It's not a drama. Okay. If it does, it works. If it works, it's great. If it doesn't, it's not a drama. I know some stuff now, and I can relook at it again. So people with a promotional bias are more likely to learn from mistakes and improve over time, but tend to get into the market very early. So almost require making mistakes in the reality of the market and making those donations to the market on a regular basis as they learn. So they will enter the market with an incomplete trading plan, have a go. Oh, that's not working. Maybe I better do something else. Whereas someone who's got a pessimism bias or a preventative bias is more likely to do the opposite in terms of learn the rules of the game to the nth degree before they enter the market. And that indeed is a quality of promotional biases. Another quality of those with a promotional bias is they're less prone to giving up after a setback. To the degree where they may blow up accounts, blow up an account or some accounts. If you listen to most people, you'll read about who've written books and are very, very successful traders. Then many of them will talk about how they've blown up an account or two. But what they do, whether it's a big setback like blowing up an account, or whether it's a little setback in terms of having a major drawdown, what they'll do is they'll take that scenario as a learning opportunity rather than an all or nothing battle. So there isn't that all or nothing battle in place. If you blow up an account, you'll just find some more money and go again if you're feeling okay about it. On a more micro level, then what those with a promotional bias do is they tend to be very good at taking signals on entry. Absolutely great at taking signals. There's a signal there and they won't ignore it. And they also are particularly good at letting profits run. The other thing is, I've a bit of a spelling mistake there, is that they're more likely to cast the trading net wider regarding potential opportunities. So these are the guys that won't say, well, I'm going to master Forex first. And then when I've absolutely mastered that, I might start to have a look at indices or share CFDs. But we'll maybe obviously do that prematurely. So if we look at the qualities of someone with a preventative bias, I've obviously got a thing here about spelling preventative right, which is going to upset me quite a lot, I think, going forward. They are less likely to be subject to minimalization bias, and we'll make sure that every box is ticked before taking action. There'll be none of this itchy trigger finger stuff that you promotional bias guys have. They'll absolutely make sure it's all in place. They only like to act on thorough knowledge and will tend to follow through on education, so complete courses, and will ask questions and double check knowledge and ask more questions just to double check the double check. Okay, so from a robustness in terms of following process, those of the preventative bias should be very good. They tend to stick more rigidly to pre-planned risk levels and tend to refrain from over positioning and over trading, which means that I've talked to you about this before. One of the most dangerous times when you're trading is when a market turns and turns quickly. Okay, and all of a sudden your 4 or 5 positions long are all in negative territory. That's a symptom of a promotional bias. So, but because those with a preventative bias tend not to overtrade to that degree or overposition, then they often are less hurt by those sudden market movements. And look, they'll be the ones who test and double test and back test and forward test and inside out test. So they'll exercise a little more caution in determining whether strategies may work or may not work. So those are the qualities. Now we'll move on to the issues. Okay, so the challenges for those with a promotional bias. Okay, I'm just going to do one little thing. If you don't mind, just waiting a second. Perfect. Okay. All good. Okay, so these are the lists that I want you to really sort of think about and think, is this me? So with those with the promotional bias, they'll tend to have late exits. So they'll have this fear of missing out thing going on. Okay, so they may not just let the profits run, but may let their profits overrun in terms of it actually goes as far as it's going to and then comes back before they accept that, hey, hang on a minute, I should have been out of this 3 bars ago. So they may give larger profits back to the market that they had in place already. So you'll find people with a promotional bias talking themselves to stay in trades. A lot of the time, people with a promotional bias won't have a physical stop on the system, but may have a stop in mind. Now, that's the approach that I take with share CFDs. There's rarely a physical stop on the system. I know where the stop is, but it requires an enormous amount of discipline to follow through on that when you've got a promotional bias, not so when you've got a preventative bias. As I said before, they are prone to over positioning or over trading, meaning on that sudden market terms, there may be a large loss. And they tend to enter sometimes prior to signal confirmation. So that itchy trigger finger syndrome is something that you'll see quite commonly. So there won't be a full candle. It'll look as though it's going, but it won't quite be there. But they'll get in anyway. Okay, because they might be in a position where they feel the market, of course. And so they are subject to minimalization bias. They'll see a price chart. They'll see a big move on a price chart, saying, "Wow, look at that! That's great!" And they'll just jump on without doing the quick check in terms of why something's moving like that, and therefore may often be on the receiving end of something that goes up fast and then down fast. And obviously they've entered at a higher level than they subsequently have to get out. So they're less likely to be thorough in analysis and revising the plan on the basis of hard evidence. Okay, although often have good judgments in terms of what's working and what's not working, that tends to be learned the hard way in terms of the market donations, as I said before. They may also be prone to bottom fishing more so than someone with a fairly strong preventative bias wouldn't consider entering a trade because they thought it gone down far enough. They would want evidence plus that not only had it gone down and started to bounce, but it had gone down, bounced, and then shown signs of even more movement to the upside. They may scale too early without evidence of reliability. We talked about that last night for those of you who were last night. For those of you who are at that session about when you should scale, when you're trading in terms of that transition. And when they're looking at longer term trades or longer term fundamental ideas, they will often ignore any counter evidence. So look for opinions which back up what they think. And therefore may get into trades without, again, doing full due diligence. And they may be unjustifiably overconfident, particularly after a succession of wins. So that could be you, perhaps. Alternatively, there may be some of these factors that you resonate with. And this is those with a preventative bias, spelled correctly. Those with a preventative bias are more likely to talk themselves out of the trades, okay? yeah, I like that, but what if this happens, and what if that happens, and what if the other happens? And they find reasons not to take signals when they're there, so they tend to enter late, if at all, or take profits early because they've got this preventative bias. Remember that the primary driver behind that is I don't want to lose, and so as soon as they're in profit, all of a sudden they don't want to lose that profit. So what happens with those with the preventative bias is they tend to be very good at keeping losses small, but they also keep profits small also. In terms of their psychology, in terms of their emotional state, if they do get a series of losses, they tend to take that harder and don't bounce back quickly. So they may take significant breaks in when they trade, and they're less likely. This again, it's just talking yourself out of something that could be more risky. So they're less likely to try new strategies or new trading instruments accordingly. So moving my stop soon. So moving my stop too soon, is that preventative? Absolutely, Douglas. So what you're doing is you're saying, the stock has moved up. Let's move that stop up because invariably what you're doing there is reducing risk. Possibly not. Possibly too soon is not the right symptom. Maybe too close, which could be too soon, I guess. But it's obviously with any stop, with a trail stop, you're trying to let the market breathe while still let the profits run. So if you're finding yourself getting, you're moving stops and then getting stopped out quickly after that, it could be that is exactly what's happening there. There may be there may be more reluctant to avoiding assets as all-time highs. Now, that may or may not be a bad thing, but it will be less common there. Again, if you look at one of the underlying fundamental issues with those with a preventative bias, it's that remember it's a talk out of trades when they should be in, rather than with a promotional bias, it's talking yourself to stay in trades when you actually shouldn't be in at all. They're less likely to scale or scale significantly slower, even if they have reliability of results. You're welcome, Rob. And if you take that longer term fundamental idea, then they'll overlook for counter evidence or counter opinions, which again is all to do with talking yourself out of taking a perfectly reasonable trading idea, and so maybe unjustifiably underconfident. So having a look at those two lists, you may find some things that that could be me. And as I said, there's going to be differing degrees, and so what we need to do is we need to find out. And really, remember I talked last night, again, for those of you who were there, we talked last night about your results being the barometer of everything, of your systems that you make, of the way you interpret markets, and of course the decisions you make on following through. So quite clearly your results are the best barometers to what's happening. Now, what does happen with results? Well, essentially this. If you have a promotional bias, you tend to have wide swings in account values. So you'll get it down 8%, up 15%, down 7%, up 10%, and may have a positive win-loss ratio, but we'll see a large variance in your average win versus average loss. So it may be that 1 month your, let's say your average loss is $200, and 1 month it may be $400 the next. Sorry, let's say average win is $200, maybe $400 the next. $400 as your average loss. And the next month comes along and it's $600 average win and $100 average loss. The next month it's $300 average win, $300 average loss. So you get that wide variance not only in your overall account value, but also in terms of what creates those results. As I said before, they may blow up accounts, but will get back into the saddle often. Generally speaking, those with a promotional bias tend to do well in trending markets, but will really get hit on a trend change or non-trending markets. And you'll see that in results. So if you start to compare results with different market circumstances, invariably a lot of these guys do particularly well in a trend. If you look at where the index trends, then you'll often see them doing very well. But if markets are choppy, or then they will not do well if there's strong reversals. And those with a preventative bias tend to have less swings in account values. But what tends to happen is they'll either get very little progress. So you'll see a situation where their account value has moved almost zero at best, and often just a gradual wearing away of account value over a period of time. They may have an unremarkable win-loss ratio in terms of it may be 50-50 or even slightly more losses than wins, but there'll be very little variance in average win versus average loss. They'll tend to be a little closer together in terms of the performance of month 1 versus month 2 versus month 3. But on the positive side, in terms of the results, they won't be the ones that lose 10-15% of an account on a big market sudden turn with a chunk of volatility alongside that. So they'll tend to survive that volatility change or change in market direction with an acceptable loss. So again, if you want to, without looking at individual trades, these are broad-based impact on results. So it may be that you find yourself in one of those two categories. And then when you drill it down into, well, look, what's creating that results, it'll be some of the challenges that we spoke about in the previous slide. So as I said, what we need to do is, it's all very well developing awareness, but then what do we do? So if you find yourself resonating one of these, it's a really tough nut to crack. And as I said before, it's something you're going to have to work on continuously. Okay, it doesn't mean it can't be done. And as you saw, there are, if you take the great qualities of someone who's got a promotional bias and the qualities of someone who's got a preventative bias, and you mirror and you match them together to find that middle ground, then that's a really good place in terms of where you are as a trader, well, where to be as a trader, and is consistent or congruent with many of the things that we've talked about in terms of the things you have to put in place as a trader to be successful in the long term. So the overall aim is to try and correct that mismatch as far as you can. And so if you're preventative in nature, move towards a more promotional orientation, and vice versa, of course. But the problem is with this, and with anything that is so deeply ingrained, which often these are, is that it requires, it's not like coming from a place of no opinion, no knowledge, and Mike says you need to keep a trading journal, and therefore, yeah, look, I'll give this a try. That isn't a big leap, but these are big leaps in terms of the amount of evidence to change. So it's the amount of evidence to suggest that you need to do something about this has to be quite substantial for that change to be sustainable. So what we need to do is we need to set ourselves almost smaller goal steps to say, right, okay, we're really going to give this a shot for the next fortnight or for the next month, and then we'll see where we are. So we start off by creating a chunk of pain by looking at the results that could have happened if we'd done the right thing. So if we hadn't got in too early, or if we hadn't let our profits, hadn't given so much of our profits back to the market, or now one little thing that's very difficult here with those of you who have a preventative bias is that we don't record, even if you do take a journal, and of course you should, but even if you do use a journal, you don't tend to record in it the trades you didn't take. So what I'm going to ask you to do, for those of you who felt that the preventative side of things works, could be for you, obviously you can measure whether you take profit early or not, because that's based on your exit. But in terms of not taking signals, you're going to have to record those trades you find yourself talking yourself out of. You're going to have to find a way of actually recording those, even for a short period of time. Now, so that the idea behind this first, if you like, tranche of measurement is to create some pain. Is to create some, well, this is what I could have won if this set of characteristics or this set of behavioral adaptations because of this bias wasn't in place. And that weight of evidence, that weight of pain evidence, even though it's not very nice to see, is often enough to say, right, okay, I now understand that this could be getting in my way as a trader. So what I'm going to do is that weight of evidence suggests that I should be checking myself. Every single trade, I need to just take that step back. Am I doing it again? Every time every time I'm looking to take a profit, I just take that step back 5 seconds, think, am I doing it again? Every time you don't take a signal, am I doing it again? Every time you don't adhere to a profit target and want that extra little bit, am I doing it again? Every time you enter a trade, you're thinking, am I entering this too early or have I got a full set of signals? So that essentially is stage 2. So stage 1 is to create the pain or create the motivation for change, and stage 2 is to actually start to double check on an ongoing basis that this is the right thing to do. And then, of course, comparing results as a result of that. So you've got your original results, this is what I could have won, and now you've got some forward results with your checks in place. So it will take some time, and as I said, these things take a massive amount of shifting. And look, for many of us who are honest with where we are as traders, then it's something that you may continually have to battle with, and you will likely slip into previous habits. But again, the key is, right, okay, I did that with that trade. That's a preventable trading error. I shouldn't have done it. And therefore, that's my reminder. I need to just pull my head in, okay, and get back to doing what I know is the right thing to do. So it's something, there's no trader I know that doesn't make a silly bugger mistake every now and then, to use the technical term. And usually these are reversion to a previous way of behaving that was a habit. We need to create new habits. We need to put new things in place. So I hope that's been interesting and useful. And as I said, I spent quite a lot of time sort of picking this apart and putting it back together again in terms of what, because if you try to read a behavioral finance research paper on this, it really is hard yards. So what I want you to do is to take actions on this. Don't just make this again, a sort of, apologies for the spelling mistake. I want you to consider those things discussed and identify what may be a fit for you now and own it, okay? And then subsequently start those 2 things I suggested. Just create yourself a little plan, right? Over the next week, I'm going to look back at the trades that I took with the things that resonated with me and see what would have happened if I'd done the right thing. If I'd not entered early, if I'd not took my profit take, if I'd not, whatever it is that resonated with you. And then, of course, you can say, right, within your plan, I'm going to do that for the next week, and then for the next 2 weeks, I'm going to make a point of stepping back every trading action I make, step back for 10 seconds, 30 seconds, whatever it is, and ask myself the question, am I doing it again? So that is really the best advice I can give you in terms of how to manage these. But as I said, it's not it's not something that will happen overnight. It's something that that will take some time, but you can develop that awareness overnight if you're honest with yourself and look in that trading mirror of yours. Okay, guys. Well, look, I hope that's been interesting, useful, giving you some things to work on in terms of another way to potentially push your trade forward. If you so really, at the end of it all, it's over to you